Now, what are the main ideas of the little book on common sense investing? Well, the first is that over the long term, stock market returns are created by real investment returns earned by businesses. This is the annual dividend yield plus their subsequent rate of earnings growth. So, in investing, the winning strategy is owning businesses, not trading stocks. So, this is a commonly held ideology of individuals like Warren Buffett, where he's like, I am buying a business. I'm not just buying a stock. I am looking at what this business is creating, the dividends that this business is paying out to their investors, and the earnings growth of this business. And that is what is going to create the actual investment return that you receive over the long term. Even though there is speculative return, when it comes to people buying up a stock for any given reason. That is not what's going to drive the stock over the long term. What drives the stock over the long term is real business fundamentals. And then another main idea is that individual businesses come and go. And given the rapid changes and competitions that we face, the failure rate of individual business is high. And there's no way to assure success by picking the funds that will beat the market. The best protection is the broadest possible diversification through all market index funds. And this obviously opens you up to exactly what Bogle is about. Bogle is about broad diversification. He is about buying index funds, buying passive funds, and not attempting to beat the stock market in some active fund that you could purchase, or trusting some hedge fund manager or portfolio manager to outpace the market. He does not believe in that. What he believes in is buying the passive diversified funds and holding on to them over the long term, which I believe is a very good idea. And I've talked to you time and time again that most of what I hold is passive funds. But I do buy some individual stocks, and I don't think Bogle would like that very much. But again, each of the things that we learn from these books, we can take and incorporate them into our own lives, but they don't have to be everything that we are about either. And so the third main idea of the little book of common sense investing is that as a group, all investors in the stock market earn its gross returns minus the costs of financial intermediation. So this is things like commissions, management fees, and the like, and then taxes. And so all this is saying is that everybody who owns the S&P 500, or everybody who owns index funds, mutual funds that are very similar to an index, things like that, are going to get the gross returns of the market less any costs of intermediation, which that means any costs towards a broker or an advisor, and then taxes. And something that Bogle is really, really headstrong about is minimizing your costs. Because it is no surprise that a couple of percent, or less than 1%, or 1%, 1.5%, whatever you may be paying to a financial advisor right now, will eat into your returns when compounded over time. It is outrageous how much just a small percentage can eat into returns over time. And so he goes very deep into how much costs can actually cost you over the long term in this particular book. And so that's a really useful thought process to have, because I agree wholeheartedly with Jack Bogle in this way, in that I don't want to be paying for advisors. I don't want to be paying for any type of management fees or any type of commissions or things like that. I want to be minimizing those things. And obviously, we want to be minimizing our tax burden as much as possible as well when we are investing. And then the last main point of the little book of common sense investing is that market timing and fund selection often lead investors to do much worse than the market. And he runs some comparisons between the S&P 500 and these particular funds that you may try to select that are actively managed, or these individuals who try to time the market and time the certain activities of the market, or the certain ebbs and flows of the market, and finds that if you just hold the index, you would have far outpaced those who tried to do those types of things. And so that is also no surprise to us, or those of you who have watched this show for any period of time. You know that I have laid those concepts out for you previously.